Let's start our discussion on GASB 68 implementation, but before I do, I'd like to tell you a little bit about our speakers. First, we have David Bean, who's the Director of Research and Technical Activities for the Governmental Accounting Standard Board. He assigns and provides oversight to GASB's research, technical, and administrative activities. We also have David Lamoureux. David is the Deputy Chief Actuary in the Actuarial Office of CalPERS. He has been with CalPERS in the role of Pension Actuary since 1999. We also have Robin Madsen. Robin is the Chief Financial Officer for CalSTRS, where she is responsible for providing leadership, strategic planning, and policy guidance to CalSTRS financial service functions. And we have Kristen Montgomery. Kristen serves as a controller for CalPERS. She manages all functions in Financial Reporting and Accounting Services Division, which includes accounts payable, accounts receivable, cashiering, pension and health accounting, investment accounting, financial reporting, and treasury management. Please welcome me in joining them.
Well, thank you. I am David Bean again, so I'm going to start the program today. First of all, I'm honored to be with my fellow panelists. They are really the people you're here to listen to. They are going to give you the specifics of what needs to be in your financial statements or your client's financial statements. But what I'm here to do is, first of all, if you're not already shocked and awed to death, as it relates to post-employment benefits, my job is to make the world even more frightening for you. I say that in not because GASB's sole goal is to make your lives miserable. It's actually to improve financial reporting. And we have done that with Statements 67 and 68 as it applies to most pension plans. But we have some unfulfilled needs out there related to pension plans that don't meet that definition of a trust that's in paragraph 3 of Statement 67 or paragraph 4 of Statement 68, whichever one you choose to memorize. And I'm sure you all have those standards memorized. But essentially, we're looking at 3 criteria. We're looking at assets being an irrevocable trust, not being subject to creditors, and can only be used for pensions. Now, you may have clients, or in your own school district situation, you may run across a plan for highly compensated employees. And you have to ask yourself, well, does those resources, if it's a defined benefit plan, does those resources meet those 3 criteria, and does it qualify for a trust? Does Statement 67 and 68 apply to your situation? If not, we have a solution for you coming. No, in the interim, you're still going to have 25 and 27 to deal with, but we have Statement number 73 coming out. And that will tell you how to report the related assets, because again, these aren't trust funds per se, so how to report the related assets in the financial statements of the school district. And then we come to the other side and how to report it from an employer's perspective. And those things will be coming down the pike in 2006 and 2007. And you're probably thinking to yourself, well, that's not so bad. You know, I'm going to get information from CalPERS and CalSTRS. You know, I'm going to move on as it relates to the big chunk of my liability, but I can fill that in. So what's the big deal? Well, the big deal is statements not 73, but 74 and 75. And that's the other post-employment benefits. In other words, the other shoe dropping. I often refer to Statements 67 and 68 as the Tammy Wynette standards. And no, it's not Stand By Your Man. It's DIVORCE. Effectively, what we did with these standards was to divorce the funding notion from accounting. Now, from your school district's perspective or your client's perspective, you may have said, well, hey, listen, I got a bill, from these two organizations. I paid the bill. I'm done, right? What do I got to worry about this thing for? Now, some of you in the audience can remember back to GASB statement number 5, where we actually required the proportionate share, or at least a allusion to a proportional share of the liability being reported in the notes of the financial statements. When we developed statements 25 and 27, we eliminated that requirement. But now we've come back with full force. Why have we done that? Well, I think, number one, environments. The environment has changed significantly over that 30-year period. And when it comes to the liability of a cost-sharing plan, when you ask someone who owes that liability, what's the general answer? It's this, right? That's the answer. It's like, well, it's not me, it's the state. Sponsor, yeah. It's not me, it's it's the actual plan itself. And I can tell you, in my auditing career, I audited pension plans. As a matter of fact, the Illinois Teachers Retirement System was one of my clients. And, I was all over the facility, and I can tell you that I did not find a printing press at all. Right? What does that mean? Well, they're not printing money. They're only going to get it through two things, right? Investment earnings and contributions. And who are those contributions going to come from? And for the first time, we have really stepped back with cost-sharing plans and said, who effectively has that liability? That's something that has not occurred to this point. And you can say, well, they don't do it in the private sector. Well, the IASB, the International Accounting Standards Board, and the International Public Sector Accounting Standards Board alludes to a calculation for cost-sharing plans, but the FASB doesn't. But the FASB is in a little different situation because they're looking at big union plans where employees, not only jump, from employer to employer, but from state to state. With governments, though, cost-sharing plans make up over 50% of all employees in defined benefit plans. It was not an issue that the board could kind of quickly look away from and say, there's not an issue here. So we felt we had to step in, we had to assign a liability, and that's why you see the significant changes that are presented in statements 67 and 68, and specifically 68 as it applies to you and your clients. Now, if 67 and 68 were the Tammy Wynette standards, what's coming forward with 74 and 75? Well, those I call the carnival standards. And you think, carnival? Well, it's an obscure Australian band out of Perth. And they do a song that essentially is more the same. And that's what OPEB is, more of the same. So if you love pensions, you're going to just absolutely be excited out of your socks as it relates to OPEB, because the liability for OPEB, and in many situations here, it's a single employer perspective. In some, it may be agent. But that liability is going to come onto the face. And the reason I mention it, and I'm taking the time today to even discuss it, is that as business officers and as auditors, it's our responsibility to let people know what's coming down the pike so there's no surprises. And I can tell you, as my colleagues up here will probably have some real-life experiences on, is that there are a lot of folks that are just coming to the realization that we have a new pension standard. And this is several years after its issuance. I mean, this thing has been going along through due process for over 10 years. But yet people are now becoming aware of the change. So, again, I realize I'm preaching to the choir here, rather than the unwashed masses. But as you talk to your colleagues, you can say, hey, guys, remember, something else is coming down the pike. As auditors, you can tell your clients, something else is coming down the pike as it relates to OPEB. So please be aware of that, not only as you prepare pensions, but as you look to your total scheme of post-employment benefits and say, yes, the other shoe is there. Now, let's focus a few minutes on Statements 68 and 71 as it applies to employers. Again, my job is to kind of tee it up, and my panelists are going to knock it out of the park. So, what are some of the big things out there? You guys will do it. No problem at all. I have faith in you. As I duck off the stage, right? It's
He did
no.
by telling us we couldn't poke holes. GASB's law.
Right. Yeah, no, it's making fun of GASB, that's a sport that many practice. And with some of our standards, I understand why people say that. They say, well, wait a second now. Why suddenly I didn't have a liability in the past and I have one now? Well, we still have the typical liabilities as it relates to our payables at year end. That doesn't change based on Statement 68. In other words, if we have the typical, our year ends on June 30th, it ends on a Thursday, and, we happen to cut payrolls on Fridays. So what do we do for that period where we haven't yet, turned over the resources to CalPERS or CalSTRS? How do I report that? Well, just as you've always had in the past. A payable is a payable. The big difference here is that amount, if material. And that's a word that you won't hear out of GASB's mouth very often, is material. The speaker before, I heard her explain should and must. I should clue you in on some GASB terminology because it's like going to In-N-Out in some respects. You know how they have the secret menu? Well, we have the secret code language of GASB. When GASB says should, what do we mean? Must, right? Hey, listen, I should lose 10 pounds. But but maybe I won't. The thing is, when GASB says should, it does mean must. When GASB says significant, what do we mean? We mean material. You say, well, guys, why don't you just say that? Well, the difference is that we have this little box at the end of our standards. It says, need not be applied to immaterial items. So if we put the word material in the standard, you guys are going to think, okay, there's something, they're trying to send us a message here. Does it mean really material? Material? And we didn't want to go through that. So we throw in another code word, and that was significant. That's when you see the word significant, we mean, guys, we really mean this. Look at that materiality box. Don't spend a lot of time on effort on things that may not be material. So if you're payable to CalPERS, CalSTRS at year end is material, there's a note disclosure requirement for that. But that's minor compared to the larger net pension liability. Again, we've gone from a world of the OPEB obligation, the net OPEB obligation, the NPO, to the NPL. And probably the only people that will ever understand that difference is right here in this room. But again, that change from obligation, which was essentially a note disclosure requirement, to liability makes all the difference in the world as far as where it's reflected in the financial statements. And with our concept statement number 4, with our concept statement number, which define the elements and which included a liability, with our concept statement number 3 on communication methods, which essentially said that notes aren't a substitute for recognition, with both of those staring us right in the face, we knew we could no longer turn away from pension liabilities and say they should not be recognized in full on the face of the financial statements. So that's what drove us down this path. Of course, you're probably saying to yourself, why'd you issue those 2 concept statements? Why don't you just forget about it, right? But that's, again, not our job as far as reflecting the financial position and results of operations of governments in the best manner possible. So we are going to have these liabilities being reflected on the financial statements, and of course, with cost-sharing plans, you're going to report a proportional share of that liability. That liability will include immediate recognition of some things that have been deferred and amortized out of the liabilities in the past. The one thing I think is absolutely key here when you have to explain this, and this is why we're spending some time on this, is because you are the people on the front lines. You're going to have to sit in front of a school board and explain to them what this liability is. But things like normal cost. In the past, there have been situations where normal cost isn't even recognized in the period. Under this standard, normal cost is recognized in that period. The interest cost is recognized immediately. Changes in the plan benefits are recognized immediately. In the past, if someone were to have an increase in a benefit or even a decrease in a benefit, those things could be amortized up to 30 years. In other words, not even when the person is no longer working, but effectively the liability was being recognized when the person was dead. So this is a big change in how we're calculating the liability and representing it on the face of the financial statements. So we have immediate recognition for those items. We have immediate recognition for the projection of the investment earnings. So if you assume a 7.6 or a 7.5 rate of return, expected rate of return, that's your long-term expected rate of return. That's what's reflected in the period. Now, so great that we have an actuary on the panel today. I'm absolutely in awe of actuaries. Why is that? Well, actuaries know 3 things about you that no one else knows. First of all, they know exactly when you're going to retire. That's a good thing to know. They know how much money you're going to make when you retire. That's also a good thing to know. But the most important thing they know when you're going to die. And they're clairvoyant, right? I always say you never want to get a hold of an actuary, though, that never wants to recognize an actuarial loss due to demographics. David's going to assume you're going to die at the age of 80. And your 80th birthday comes, you're there celebrating with your family, your kids, your grandkids, your great-grandkids, having the time of your life. You hear a knock on the door.
Don't open.
David's there. He goes, "Shh, time to go." No more actuarial losses for me. But anyway, but they're not clairvoyant. I wish they were, but they're not. And therefore, we do have gains and losses because of assumed versus actuals. Nobody can predict interest rates. I can guarantee you, if you could predict interest rates, you wouldn't be in the audience right now. So therefore, what we're trying to accomplish is to recognize the cost of these pension benefits over the service lives of the employees. And we recognize there are cycles for investment earnings, and that's a 5-year cycle. We try to, again, by recognizing the cost based on when services are being provided, we're saying that these types of changes, where there's a difference between assumed and actual, we're going to recognize those over the remaining service lives of the employees associated with the plans. And when we talk about employees, we're not only talking about active employees, we're talking about retired employees. So those are the things that we're trying to reflect in the financial statements with this new standard. And explaining that, what's included, what's excluded, is a key to the understanding. Now, there are some things as far as measurement issues, and we're going to get into more detail, specifically as it relates to CalPERS and CalSTRS in the next couple of presentations. So I'm just going to kind of highlight a few things and then let the real experts talk as it relates to what you'll face in California. But on the measurement side, a big thing here is that there can be a delay in effectively when we recognize things in the financial statements. Now, from an accountant standpoint, when do we measure liabilities? As of the end of the reporting period. I mean, that's what we're taught from day one, right? That's when we measure a liability, as of that date. However, there's some really practical considerations associated with pensions and with OPEB. And if we were to say that we're going to measure the liability, because this standard is effective this year, we're going to measure that liability as of June 30, 2013. When would those financial statements be issued? 13. Yeah. Yeah, well, we're not going to get those financial statements out in 6 months. We're not going to get those financial statements out in 6 months. So the board said you can go back 1 year. 1 year. And again, they'll show you a timeline about how the measurement, when do we have an actuarial evaluation, when do we measure the liability, when that's reflected in the financial statements. But essentially, for a June 30th, 15-year end, we can have a liability that can be measured as of June 30th, 2014. The key thing here is to clearly identify that in the notes of the financial statements. When you're presenting the information to boards, to point that out because of timing reasons, and it's strictly timing reasons only, that the board did allow that liability to be up to a year old. Also, please remember that there's also a requirement to adjust opening balances. And that opening balances, so if you're using a June 30th, 14 date for your ending balance, you're using a June 30th, 13 date to adjust your beginning balances. So, again, that's hard to explain to people sometimes of, well, why doesn't this quite mesh up? Because of that difference, because of that 1 year period, we say in Statement 68 that you don't have to worry about deferrals. Because again, we're recognizing the full liability. There's no amortization in that liability. We take those differences and run those through deferred inflows and deferred outflows. So if there's a difference between actual earnings on investments and the projected earnings on investments, that difference is deferred and then recognized over the next 5 years on a closed basis. But what we said, don't worry about those things until the end of the first year. But then people came up with an issue and said, well, wait a second. If I measure the liability as of 14, what about my contributions this year? If I defer all of those, I have no pension cost for this year. That doesn't make any sense. And our response was, yeah, you're right. We need to recognize that deferral in our opening balances. And that's what Statement 71 was all about, is to say those contributions made after the measurement date need to be deferred because cash has gone out the door. We've reported a liability at year end for those amounts due to the plan. What is going to be our debit? Deferred outflow of resources. And that's how we get the big books in the sky to balance. Another issue that is not as big of an issue for school districts, but it is, something that you should consider, is do I have an enterprise fund? And if I have an enterprise fund, is that enterprise fund, does it have an obligation or a liability associated with pensions? In other words, are they going to be paying off the pensions? If that enterprise fund is going to be paying off their portion of the pension liability, then a portion of the liability is allocated to the school district. Portion should be subdivided and allocated to that enterprise fund. That's based on good old NCGA 1 going back to 1979. That principle has been there all along. This standard just highlights that allocation provision. Now, we could spend a lot of time, going through the statements, but what I'd like to do, because I've chewed up my portion, and I could spend the next half an hour or an hour or 3 days with you, if you'd like. But what I'd like to do is turn things over to my colleagues and let them tell you how it is being applied in both CalSTRS and CalPERS, and we can come back with your questions as we go along. So with that, I'll turn things over to Robin.
Thank you, David. And I really would appreciate dialogue and questions as I go through, so please don't hesitate to interrupt the discussion. We also may dialogue amongst ourselves because how we're reporting in your books is a combination of information that we're providing to you. So I think something that one of us says might trigger a question that you would have for the other system. So we want to make sure we welcome you to that kind of a dialogue. What I'm going to try and do is take the principles that David laid out and show you how we've tried to address them from the plan perspective. I'll also have some information for you on the analysis we've done as an employer under 68 and just identifying the additional note disclosures that are required. So to the extent that I can share that with you, I'll do that. I'll also try and reference back to our CAFR. The information that I'm talking about today is all published in our CAFR. It's out on our .com site. So to the extent that I have page numbers that I can give you, you can go directly to that document. We are now in the throes of moving to this year's financial statements. So where I have forgotten the specifics, I'll refer to my notes and my CAFR, but it is all available to you online. So I'll try and provide that information as we go through. So from my perspective, whoops. I need to get you through your other.
Sorry, I thought I
No, it's
down
okay.
here, but
Oh, maybe. Oh, yeah, it's going backwards. Sorry, wrong way. Let's see if I can get there. There we go. That was my error. Sorry. So I want to go through the timeline as it relates to CalSTRS, how we have what the NPL is, how we have disclosed that, and where. I'll give you some visibility into our schedules of proportionate share and total pension obligations. And then we'll have some information on sample note disclosures, some employer tools that we've made available online to either your clients or you as employers. And like I said, there's a slide in here for questions, but I hope that we have that as a dialogue as we're going through so we can address those topically. The first thing I want to talk about is this timeline, and for CalSTRS, either you or your clients will have a choice. Our financial statements are published and available at our November board meeting. So the first week in November, we will have information for fiscal year 14-15 available. So there is a choice that an employer needs to make depending on the timing of their financial statements, to the extent that they want to disclose the CalSTRS NPL as of 6/30/15, that will be available. So we have gone through and prepared the plan information for 13-14. It is in the CAFR. We will be doing the same thing for 14-15. I will refer to the 13-14 information because obviously that's published and you can get back to it. Our CAFR includes the schedule of proportionate share and the aggregated amounts. So we were on the bleeding edge there. And so as we have learned through the course of this fiscal year, or you had feedback for us, We will endeavor to make those changes next year, this year or next year. Can't promise things, but we definitely have gone through an update or a refresh of our technology to support this, because we received funding through a law that went into effect July 1st of 2014. So we are now in a multiple rate environment, which we hadn't been before. So we've made a lot of changes, and we will continue to improve those tools, we hope, for you. So this is the timeline, and it shows the look back to the actuarial valuation that occurred for June 30th of 13, which we prepared and presented in April of 14. We did a roll forward to get to June 30th of 14, and that's the information that is the basis for the NPL in our financial statements. Because of the timing of the release, again, like I said, your clients or you could wait for the 14-15 statements.
So let me chime in from CalPERS perspective.
Yeah.
So again, CalPERS financials are also done in November, but the GASB 68 accounting valuation report will not be done probably until November also, but we also have to wait for our auditors to review that. There are some differences between what's in our financial statements versus what is in the GASB accounting valuation report. So if you're going to choose the timing, you got to look at both plans probably.
Right, no, I think that's absolutely true. That's absolutely true. Or again, disclosures become more difficult if you've got different timing for the different components of your employee population. So, good comment. Okay, in terms of what we see as the key changes for employers, again, as David presented, you are, in fact, reporting your proportionate share of the total net pension liability for the CalSTRS pension. Now, your proportionate share is based on a subset of the total net pension liability because our sponsor is a non-employer contributing entity, and they have about 37% of the liability. So, again, the state is a non-employer contributing entity under the CalSTRS plan, and they take a chunk of the liability off the books from the employer's perspective right away. So our schedule of proportionate share identifies that, and you'll note that the total from the employer perspective is only about 63%. So that's why. Again, the pension expense is the change in the NPL from year to year. David talked about the need to restate the beginning balances. And again, on the state's, on behalf of contribution, the employer, you or your client are going to recognize that both as a revenue and an expense item. So you have to do both sides. So that's something that needs to be taken into consideration as it passes through the income statement changes. Before we got the legislation that went into effect, the full funding legislation that went into effect in July, we were actually projecting that we would have a deficit and would have to have used a crossover rate, so a blended rate, because the plan would have run out of assets to pay those liabilities. Fortunately, based on the fact that the legislature and the governor signed our full funding bill, that did not need to occur. So we did discount liabilities using the assumed rate of return. Let's see, nothing else I wanted to highlight there. Again, deferred inflows and outflows, which are comprised of things, some of which CalSTRS is going to provide to you and your client, and some of which the employer will need to determine themselves. So I want to highlight those things because we've got differences in expected and actual experience that will be from CalSTRS. There is none. Again, we were in a situation where we used the 13 valuation to roll forward to 14, so there's no changes in this first year. Changes in assumptions, again, no changes in this first year, but that would be coming from CalSTRS. The differences between expected and actual investment returns, there are those deferred items this year that is coming from CalSTRS. We earned significantly more than the assumed rate of return, so you'll see that credit in there. Changes in proportionate share. Now, this is something the employer will need to do. So we will supply the proportionate share for each year, so those factors will be in there, but the employer is going to need to determine that delta. And the differences between the actual contributions and their proportionate share is, again, something the employer is going to need to determine. And obviously, our CAFR got significantly bigger, as will, I'm sure, the employers. there's just a lot more disclosure. So I think, David's point about being able to explain it to people is really important. You can't just look at the financials and understand what has happened. It really will create certain kinds of confusion. And for us, what we chose to do was to present the information for the state teachers' retirement plan, not just the defined benefit program. So it's a combination of our defined benefit program, our defined benefit supplement program, and our cash balance program, as well as our replacement benefits program. And that all combines to be the state teachers' retirement plan. So people may be pulling actuarial valuation information just for the DB portion of that plan, and that's going to be different than you see not only from the divorce of funding and accounting, but also from the combination of those programs. So again, just lots of layers here that are nuanced and may create opportunities for people to be confused and ask you questions. So it's important that that you or your clients understand what you've got in your note disclosures so we can address those kinds of questions from our constituents. In terms of the actual results for CalSTRS, these dollars are obviously in millions, so we're at a $58 billion NPL. It's a 77% ratio. This information is for 6/30/14. And it's included on our Note 3 in our CAFR. So a very extensive Note 3 with all the funding and the pension liability information included there. We did try in our MD&A, so this may be helpful to you or your clients, explain the transition that has occurred from the reader's perspective. So might be helpful for bond disclosures, might be helpful for the school board, might be helpful to answer questions from the media. So again, that's something that you can leverage if you so choose. Again, this talks about the roll forward, the assumptions that our board adopted. So our board adopted valuation assumptions for the STRIP that are very similar to what we had assumed for our DB plan. We did use a discount rate that was free from administrative expenses, so that bumped it from 7.5 to 7.6. Like I indicated earlier, there was no crossover point where the assets were depleted, so we were able to use that discount rate for the liabilities. We have included sensitivity analysis, GASB required plus and minus 1%, so if you assume we have 3. And the reason we did that is because we had done that previously in our MD&A, and it really does help answer people's questions about what would happen if your investment rate of return either is increased or decreased, particularly on the lower side. People want to know that. And so we continue to publish that information, and I don't expect that we'll change that. That's just part of what we're doing.
And I want to note a difference with CalPERS on especially the discount rate, and David chime in, but we assumed it was net of admin fees. So that's a big difference between the two plans. So we wanted to call that out to all of you so when you disclose that.
And it will be mentioned in the report. We basically decided to stay with the 7.5% discount rate for both accounting and funding. So just be aware that will be
well, and it's certainly possible over time, given the difference in risk appetite from asset allocation perspectives, that you will see differences that are based on the actual assumed rate of return. I mean, that's conceptually possible for the two different plans, that you'll have different assumed rates of return based on the asset allocation targets and risk tolerance. So again, I think this nuance is a nuance in this particular case because our assumed rates of return are the same, but it's certainly possible that they could be different. The next, what I try to do here, and again, this really ties back to people's attention to actuarial valuations, is show you how we get from the funding perspective to the accounting perspective. And I don't expect you to be able to read this here, nor do I necessarily want to go through it, but we do give you the ingredients of those differences, and I think that might be helpful in your communication to constituencies, stakeholders, those kinds of needs from a communication perspective. So hopefully you can take advantage of this information, and we'll continue to have it in our deck. It really correlates to information that ties back to the actuarial valuation, which is again, typically presented in April. So it's in April of the year following the actuarial valuation date from our board perspective. I don't know what your cycle is.
And our schedule is exactly the same. We presented the June 30, 2014 results in April as well.
Right, so that, again, from a communication perspective, we are pretty much the same. This next slide just talks about the roll forward. All of this information is in fact included in RSI Schedule 1, which is on page 77 of our CAFR. So it's up here in a different display, but the information is the same as is presented in the CAFR. So again, just letting you know what the pieces of data are that are available. Now I'm going to go in and talk a little bit about what the CPA proposed and how we've deployed that. So this was coming out of the expert panel. We really relied on this information because we were trying to incorporate this in our financial statements for the period ending 6/30/14, and we were in a time crunch. So as soon as they came out with a white paper, we really made decisions in terms of how we were going to present information in the financials in a way that we could get an audited, an unmodified opinion, as well as the opinion on our schedule of proportionate share and aggregate pension amounts. So the ICPA was proposing at that point in time the schedule of employer allocations, so we have done that. That's for cost-sharing plans. We used current year contributions, so this is where policy comes into play. And as I've talked to school districts, county offices of education, and clearly you, we use current year contributions as the best representation of information that we have available for future contributions. But your client or you might have better, different information than we have. So we can give you what we've got, and we can explain how we got to those numbers, and we had auditors look at our numbers, but that doesn't mean that that's really reflective of what you or your clients should be using. So I have tried to emphasize as I've talked to groups that there is a need to set a policy around this. I don't, again, as David alluded to, it's been really sleepy until very recently. So I'm nervous from my seat in terms of the volume of questions that we're going to get just as we're in financial statement preparation mode. So just, again, be alert to the fact that needs to be done. In terms of our estimates, we used current year contributions. We also used contributions received for prior years, and we have both accruals and accrual reversals for those contributions that we had not received by the end of the reporting period. So you'll see those adjustments, and we did provide visibility into those adjustments for the employer community so they can see it, but again, decisions have to be made. Our auditor tested the schedule of proportionate share at a different materiality level than they did for the plan as a whole, but for certain kinds of employers that might not be adequate. So again, they went down to a different level of detail in materiality standards than they did for our financial statements as a whole, but you and your clients will need to talk about what that means given their proportionate share. We also took the proportionate share out only to 5 decimal points, and I don't know how far yours goes.
I think ours was 4.
Okay. So again, the ingredients are there because we give you the numerator and the denominator. You can calculate it out farther, but that's how the schedule is presented. And again, this is on page 95, begins on page 95 of our CAFR. The audit opinion is on page 93. This is a place where we deviated from the AICPA recommendations, at least as they were presented. There was a recommendation that we then take that proportionate share, apply it to the aggregate pension amounts, and prepare a schedule by employer. We did not do that. We did it for the plan as a whole because, again, it isn't our decision to make as to whether that proportionate share is representative of what the employer's proportionate share is, because they may have better information. So we didn't do that math. The math is available, but we didn't do it because, again, there's a choice to be made. This is our Schedule X, and it begins on page 127 of the CAFR. So it is for aggregate amounts. And I have shared with people, if they choose to adopt a policy where current year contributions are a representation of what they think their future contributions will be, they could do the math very simply from that information based on their policy sets. The next thing I've got are some snippets of what these schedules look like. Again, not necessarily what I expect will be important to you today, but just wanted to give you some perspective on it. I will point out that we, in this, reconcile to the contribution revenue number on the face of our financials, and so there are contributions in our revenue number that are not included in the scheduled proportionate share because they're for very specific pension obligations. So they're not, they're for purchase of additional service credit, retirement enhancements, so they don't belong in that cost-sharing allocation. So you'll see that, you'll see the state's contribution, you'll see our accruals, those kinds of things. So again, this is on 126 of the CAFR. This is the schedule that's available that I indicated in that other display, provides similar information. So this is the total pension liability, the pension expense, and then the calculation of deferred, in this case, just inflows of resources, because those are the only adjustments that we have in this first period. So I'm not going to get to these. And I'm not quite sure how to get these to you, but we'll figure that out. So we have attached sample Word files that show what our employer disclosure would have been under 27 and what we think the employer disclosure will be under 68 for CalSTRS as a cost-sharing employer. And what I'll tell you is that the disclosure got very, very, very much larger. But we did that research and we're happy to share that. So again, I have to figure out how to get that to you because it didn't come through as printed in the deck. In terms of employer tools, one of the things that's going to be a dilemma, I think, as school districts begin to use this information is that their numbers and our numbers are not going to match to the penny. First of all, even if everything was perfect, we have accruals in there that are not necessarily going to match your numbers from a payroll perspective because we don't have those files yet, or we didn't have those files yet. So there's certainly going to be a difference from that. So we're trying to provide reports that will give you visibility into that. The tools are based on the way we get information from the county offices of education. So again, your employers, if you are an employer or your clients may not have used these tools in the past. They didn't need to because they didn't have responsibility for actually getting the data to CalSTRS. Some of the language is going to be unusual. I mean, we talk about media IDs because that's what we talk about the label for that file being. So I just want to make sure you're aware of the fact that those tools exist. There may need to be some translation discussions. We're happy to help you with that. We have also been working this past year to improve the tools, so what we have now and what we're going to have in 2 or 3 months will be different, but we do have this information. And the way people get to it is that they use the Secure Employer website, which is how county offices of education or direct reports transmit files and information about their deposits to us. So we've added information to that toolkit. Employers will get authorization to go into the SEW through their county offices if they're not direct reports. And they provide access. There is a registration process. The way it looks like on our website is, this is our .com site, so it looks this way. There are layers down. And then this slide actually shows you a reconciliation report, shows you what we have in terms of the contributions by media ID, and then how we adjusted that for the reversal and the accrual in the current period. And then that should tie back to the face of the schedule of proportionate share. That numerator piece should match this underlining data set. There's a job aid that explains the reporting. There are new tools that are coming out for this fiscal year that will take that data at a macro level and drill it down so you can see member by member what we have on our records. So this coming year, the work that you as auditors or your auditors are going to need to do might be facilitated by those lower level reports, because you'll be able to pull those and do matches against payroll records. This year we don't have that, for 13-14 we didn't have that ready. This is just general information on GASB 6768. Again, PERS has a very robust web presence on this as well, lots of FAQs, and then this is contact information. So we're happy to help you. Our response time is going to be somewhat variable based on when you call. We'll let you know if it's going to take a while. Certainly before we get to July 20th is going to be better than after July 20th. That's when my books close and I go into financial statement prep mode for year end. So anything you can do to research and get us your questions before that point in time will help me for sure. Other questions?
Just at the 50,000 foot level for just schools in general, basically switching to the new process, is their expense going to go up significantly on a go-forward basis?
You mean in terms of preparing financial statements?
I mean, in terms of what's the cost, like in terms of the rate that they used to have to pay CalSTRS was kind of like before an easy thing, right? It was just
So we want to have you repeat the question. Sorry about that.
You want me to have him?
So I think I heard a question about is the contribution rate going to change?
exactly. Is the contribution rate going to be significantly different, and specifically if you expect it to be higher?
Right. So our contribution rates, unlike PERS, are set in law. So we have had a significant change, and contributions are going up, but it's not anything to do with this process. It's because the legislature and the governor have signed legislation that was a product of lots of negotiations over 10 years to bring CalSTRS to a point where we could be fully funded. So our funding ratio was on a downward trend. We were going to run out of money. And so without that change in legislation to increase our contribution rates, we would have had a crossover point. So our NPL would have been about 3 times as big as you're seeing it now, more than 3 times as big. So yes, contribution rates are increasing for members, employers, and the state. The way we were able to construct a legal increase in member contributions, because again, in the state of California, that is a contractual right, is we actually have made the annual benefit enhancement, which used to be optional, obligatory for people who are making contributions under this new plan. So there is no opportunity for the legislature to take that annual benefit enhancement away, and so that was the benefit enhancement that allowed us to increase the contributions due from members. And there's a sliding increase. The member contributions and the state contributions go up over a 3-year period. Employer contributions increase over a 7-year period. So, did I answer your question?
Sort of, but
Sorry.
But it sounds like, though, at the end of the day, though, the rate, it's not like if let's say, for example, the actuarial changes their assumptions or other things are changing, and it looks like the position of the funding is changing. The CalSTRS rate is kind of like, again, more set in legislative action as opposed to like evaluating it, looking at, okay, there's been some changes, net our liabilities is changing, and automatically then, based upon those assumptions, you would do some type of change that would more proactively, without the legislature having to take action, make a change.
So stylistically, the way rates are set for CalSTRS and the way rates are set for CalPERS are very different. You know, ours are set in legislation. What I want to clarify, and the reason I'm saying more than just yes or no, is that within this new legislation, the board has very limited rate adjustment authority. So if we are more funded than we expected to be, the board can decrease the rates for the state and the employer within a very small window. The opposite would be the case as well.
And for us at CalPERS, just so I'm assuming everyone is aware, but the CalPERS board has full authority to set the contribution requirement. We do that every year in April, and we do expect these contributions to increase over the next 5, 6, 7 years. One of those reasons, with the one you quoted, our board did approve an assumption change that will start to be reflected in the school's contribution rate starting in 16, 17, and we phased in over a 5-year period. So we expect these rates to go up, and we've provided all school districts a document that shows a projection of the contribution rates going out, I think, to fiscal year 2021. And that is a document that's available on our website as well.
There are a couple of questions that are coming in from the web. I don't believe that they're directed at any one individual, so please, anybody feel free to chime in on this one. The first question that came in, it says, what's the definition of covered payroll? It's not defined in GASB 68. Where can I find the definition so I can provide this to my clients? Thanks.
We're going to turn that over to Mr. B.
There is a difference between Statement 27 and Statement 68 as it relates to covered payroll. Some people who have a really focused eye will notice that the term changed. It changed from covered payroll to covered employee payroll. And the intent of that is to align it, first of all, it aligns with the OPEB standard where it includes all payroll, not just those associated specifically with pensions. Because when we talked about covered payroll in the past, people would say, well, it's only pensionable payroll. This includes all payroll. So that and that was clarified in our implementation guide. So that's where they would find that discussion. But it has certainly raised issues, particularly on the plan side, because of course the employer would have that information. That is information that the plan would either have to get from the employers or estimate.
So I'm going to come right out and say we missed the change. So our Schedule 2 has a column called Covered Employee Payroll, and that is what we get from employers, which may not be the total payroll. If it's not coming in on our compensation files, we won't have gotten it. We'll try and make a change in the 14-15 financial statements. We're going to have to do that based on estimates until we can figure out another way to get the data, because it's not information that we have, and I've been a participant in discussions where there's a broad community that has the same problem. So we'll try and let you know what we're doing by footnoting it, but my approach is to try and create some kind of estimate so you at least have that on a statewide basis.
Next question. For charter school audit reports that follow FASB, does CDE or other governing agencies require an implementation of GASB 68? If not, would these agencies like to see anything in the report and or notes with information required in GASB 68?
Boy, you want to try?
Yeah.
And then I'll add something about IRS guidelines as well.
Okay. First, when you say charter schools and you say FASB, there's a question. One of the things that neither the FASB or the GASB attempts to get into is jurisdiction. In other words, who falls where. There is, as most of you know, there is a definition of government in the and that definition is incorporated into the ASCPA literature. It was something that years ago the FASB and GASB staffs got together with oversights from the board, and they thought the best way to communicate jurisdiction was through the AICPA. So there's an agreement. The AICPA incorporated that definition into the audit guide for state and local governments. It's also included in the healthcare guide and several other places in the AICPA literature. So the first thing I would encourage the person to do is to go back and take a look at the definition of government to see if the appropriate classification has been made. And the only reason I say that, again, I'm not here to say decisions were right or wrong, it's just that many, and it depends on oversight, the like, but many charter schools are under GASB jurisdiction. So that's number one. But number two is if they do not, if they are considered to be an FASB entity, this standard would not apply to them.
Right, and we have included charter schools in our scheduled proportionate share. We do have quite a few charter schools, so they're there. I would also suggest that it would be important to look at IRS regulations.
Yeah, and CalPERS has also included charter schools in their proportionate share.
We have one final question for you before you move on. Sorry about that. What did the STRS and PERS auditors do related to census data testing? How much detailed testing would you expect the district's auditors to do related to census data specifically?
So I think we'll both answer it. We have two different auditors, so we can give you a different perspective on what they did. We're actually in the second round of census data testing. We have a sample that is selected based on scale as recommended by the AICPA, as well as a random component, just so we have the broad coverage. We wanted to make sure that we didn't eliminate small employers, so they're definitely in our sample. The census data testing was done on-site and using analytics. The staff was a combination of our auditors, external auditor staff, as well as our internal audit staff. We do have an opinion included in our CAFR regarding that schedule of proportionate share and the aggregate pension amounts, as well as the note disclosures that go along with those. It will be, in my opinion, I'm not an auditor. I have always been a preparer. I'm certain it will be a conversation between the preparer and the auditor as to what level of additional work needs to be done based on what we have already provided. I think that may vary based on scale. So that would be my...
Yes, and with CalPERS, it was based on scale, and it was very similar. We had our internal audit staff go out and do the audit of all the different census data. So, and everything else was the same as what CalSTRS just said.
Yeah, but this effectively has been a perfect storm as it relates to not only preparers but auditors. In the fact that not only do you have a brand new GASB standard to deal with, but you also have new auditing literature. For many years, a lot of people have said, well, why now? And I guess it depends on if you're a glass half full or a glass half empty person. You could look at it and say, well, we lucked out. We didn't have to do anything in the past. And suddenly, now things are just catching up, and I guess that would be the glass half full person, But it is something with the new standards. The AICPA took a fresh look at pension auditing and made the determination that the auditing standards needed to be improved because many firms were not auditing at the level, at least, that the AICPA felt was appropriate. So you not only get the cost associated with implementing the GASB standard, but you also get the cost associated with the new auditing requirements together. And I know I had a conversation with the chief actuary at CalPERS, as far as breaking down when we talked about, well, what was the increased cost, and what was it associated? How much of that was associated with GASB versus how much was associated with the new AICPA standards? And I'll just say the answer was surprising. Surprising from the standpoint of a lot of the cost was associated with the new auditing standards.
Yeah, our audit fees increased substantially as a result of this change.
There's one final question I'll have for you before you can move on. This last question, can a district use available reserves to pay down its proportionate share of the NPL?
we don't have a legal way to accept any pay down.
And same thing at CalPERS. Even if an employer wanted to send more money to CalPERS, they would just be sending more money to the other school districts in the process as well, because it would be allocated to everyone based on their share of the payroll. So that we're telling school district it's also not a possibility at CalPERS just because the way we're set up.
Okay, so let's move on. We're going to cover, I'm not going to go in much fundamentals because that's been pretty much done, but we can talk about some of the terminology between funding versus accounting. We're going to be talking about the reports. I'll probably piggyback off what Robin has said and say, how are we different, more so than anything? And really talk more about where our reports are going to be. It's a little bit different than what Robin was talking about. And I will talk about the lovely fee that we are charging that CalSTRS is not charging. It's not always a happy subject, but we'll talk about that a little bit too. So, I think we talked a lot about this, but I'm going to say it over again. Accounting does not equal funding. And a lot of people, as David said, you're just getting into this. Do not use the funding reports. You cannot use them. And I say that every time I'm out there to make sure that everybody understands that. We will be issuing a separate report for GASB 68, GASB 68 Accounting Valuation Report. I think all the rest of this stuff we've covered already, so I'll just move on. Again, these are just the highlights. I don't think I need to cover any of this stuff. And then this is something that a lot of our employers, they like it because they're so used to doing the funding from GASB 27, so they want to know the difference. So I'll kind of turn it over to Dave if you want to kind of explain the difference between our pension terminology and our GASB terminology.
And again, this is a perfect example of the divorce that David mentioned earlier. We have, for exactly the same, if you want, the same equivalent, we're now going to have a different term for the funding valuation versus the accounting valuation. So even though the numbers may not be the same, in some cases they will be. But if you're ever looking to see, if you look at your funding report and you try to find out where's that number in my accounting report or vice versa, you need to know what the terms are. So there is something we put in our pension funding report that we call the present value of benefits that you will not see in any accounting reports. It's just not a number that it needs to be disclosed in an accounting valuation, but we always show it in our funding valuation. David earlier in his presentation mentioned the term normal cost. I think that's what most people are used to here. It's the annual cost of the benefit. In GASB term now, it's called service cost. So if you're looking for what the service cost is in the funding report, you got to look for the word normal cost. Accrued liability, what you've been used to here, it's now called total pension liability. Those two amounts at CalPERS, we expect them to be the same at the pool level. They'll be exactly the same. You've got the market value of assets that we use on the funding side, called now the planned fiduciary net position. The unfunded accrued liability is now called the net pension liability. And then what we like to refer to as actuaries, like David mentioned, unfortunately people don't die the day they're supposed to. We refer to those as gains and losses in the actuarial world. In GASB world now, they're going to be referred to as deferred inflows and outflows.
So I'm planning to live to 100, so I'm going to be your worst.
You're fine. Just be aware of what we call the MEU at CalPERS. It's the Mortality Enforcement Unit.
Okay, so what are we planning to do? We're a little bit behind, I guess, with regards to CalSTRS. As CalSTRS kind of said, it's all in their financials. We also have this information in our financials. If you look at our financials, it's Perf B. Those are the school. We had to split our fund into 3 different categories, where the agent multiple employer plans, the school cost-sharing plans, and our public agency cost-sharing plans. So if you look in our CAFR, it's Perf B. But the other thing that we are doing is we'll first look at the schedule of employer allocations. We took the contributions all the way up through March. So for the last fiscal year, we waited until March 6th to do the allocations. So we waited for all of you to get in the adjustments, get in those suspended files, all that type of information into our application, the MyCalPERS, to be able to really do the allocation. So you didn't have to worry about the accruals and everything else. So when you get the this allocation, you can look in the MyCalPERS, and it should you should be able to match it up with your information. If you can't, then it must be either the suspended file or you did an adjustment after that point in time. Again, we want to limit the number of calls, so what we're trying to encourage is go look into the MyCalPERS application to see what the contributions and why it's different and that type of thing. The next one is the scheduled pension amounts by employer. We are, again, we're not doing the math for you. So same thing that Robin talked about. We're going to do it at the aggregate. So you're going to get an aggregate report. And the thing that we have, again, it's in the CAFR, but we have a couple adjustments that we had to do between the CAFR and the report that's going out to you. And it's mainly because of a program we offer, which is the 1959 Survivor Program. For our CAFR, we needed to include these numbers in there, but when we put this report out to you, we feel that that's not, we can't allocate it out to you, so there is a difference in there. We're going to identify it in the report. We talk about it in the report, so you're going to see this. That's what that's about. And then the last thing is engaging our employer and looking at all of these different reports.
And just going back to the 59 Survivor, just so most of you are aware, this is a program that is very, very, very small in compared to the overall. It's immaterial in our opinion.
Yes.
It's also a program that's about 400% or 500% funded that is currently being funded solely by member contributions. So from an employer perspective about putting a cost on the employer's book, it's actually a program that right now costs nothing to the employer. So,
Right. So it's not your liability.
Yeah. And I think the primary driver of the AICPA recommendation was the fact that there's a provision in 68 that says that if you have different employers that have different contribution rates because of the mix of employees. For example, a local government that has heavy law enforcement or heavy fire protection, that the rates could be substantially different, which could affect the allocation. But when you have something that's more homogeneous, such as a school district, it's a different situation. Mm-hmm. So the ability to just say, your proportion is this, and you can apply it equally to liabilities across the board is certainly, in conformance with our standards.
Okay. So we are working on the reports right now. We will be issuing them out in June of 2015. So unlike CalSTRS, they've probably been out for a long time. Yes? November. So we are just producing them right now and have our auditors looking at this. Once we have this finished, we're going to publish the reports on our CalPERS online. So they'll be out there for you to look at them, pick them up, all that type of thing. You do not need to log in. Again, because it's an aggregate for all of schools, we didn't have to use the MyCalPERS application to pull it separately. And we'll issue a circular letter to give more information as soon as the reports are all available.
I'll talk about this a little bit. So again, going back to that divorce, if you want, we just want to kind of point out where things are similar and where they're different between what we do on the funding and what we do on the accounting. Because what you got to keep in mind now is what you're going to pay to CalPERS for pension purposes, what the school districts will pay, will not equal the pension expense that employers have to report. And it's quite likely that in the first year, actually, you'll have to report a lower pension expense at what you have to pay to CalPERS because of some of these rules and what took place. But the main thing we've mentioned earlier is the discount rate, because we've done the crossover testing for the schools. We're able to use the long-term expected rate of return. The only difference here is that our 7.5, like we mentioned before, that is a number that is net of admin expenses. In accordance with GASB, we should have used a number that is gross of admin expenses. Had we followed GASB specifically, we would have had to use a 7.65 discount rate instead of 7.5. We chose to use 7.5 still for all the employers at CalPERS. So even in our CAFRA, we had to put some disclosure language that we did not fully comply with the accounting standard, but that the impact was at the plan level was not material. And there will be enough information in the report that we will publish that someone will be able to opine whether or not it is material to the employer. So that's the thing. Other than that, all the other assumptions will be the same. The cost method that we call the entry age normal that is dictated, that GASB says must be used is what we've used all along at CalPERS, so no issue there. Same thing with the assets. We've been using the market value of assets for the last few years at CalPERS. Where things tend to differ, and that's where you're going to see is where the real divorce occurs now between pension expense and what you pay to CalPERS, are the rules regarding how you amortize or how you reflect things over time. At CalPERS, when we have what we call gains and losses, we amortize them over a 30-year period. GASB said that has to be over what's called the average expected remaining service lives, which will be somewhere around 4 to 5. So you can kind of see how big the difference is right there.
And yours was, with CalSTRS, it was 7 years. Is that?
I believe so.
Yeah.
Correct.
Yeah.
And the way, if you look at how GASB did it, it said if you do a calculation for your active employees, you may get like something like 14, but then you're supposed to assign 0 to all your retirees and inactive members and come up with the average. For us, it looks like it's going to come in below 5. Then same thing with the changes in assumptions. For us, we amortize things over 5 years. GASB, same thing. It's that what we call ERSO on our side. Then on the asset, 30 years at CalPERS. With GASB, it's a 5-year recognition. And then plan amendments. If we ever go back into the world of plan amendments, it may, we would amortize them over 20 years from a funding perspective at CalPERS. GASB says those got to be recognized immediately. And the reason why I said that in year 1 at CalPERS, likely that the pension expense may come in lower than what you pay to CalPERS to fund the benefits, it's because of the asset investment gain and loss. In year 1 of GASB, we're going to be recognizing the 13-14. What happened in the 13-14 measurement period, that's the year where CalPERS had an 18% return. We've amortized that impact over a 20-year period, over a 30-year period for funding purposes. And we're bringing these gains, if you want, over a 5-year period for accounting purposes. So you're going to see this real divorce going forward, where in some years you will pay more to CalPERS than what you report, and vice versa. So
we had actually some of the same and some differences, but because our contribution rates are set in law, it really is an intellectual exercise rather than a cash impact.
Okay, I think I covered this. So this slide just tells you what we did with regards to the schedule of employer allocations. Again, to reiterate, we waited until March 6th to pull the data out. So, and again, use my CalPERS if you see any differences and that type of thing. And then our GASB accounting valuation report, again, it's going to be at the aggregate. That's basically what we're trying to show here. You'll get all the information to do your disclosures, target allocation, all that sensitivity, plus and minus 1. But again, it's at the aggregate and you have to do the math. So as we talked about before. The last thing is the fee. So we do have a fee for GASB 68 information. Because our fund is a qualified trust, we could not have the cost of the work that we're performing to just flow through and be paid by the trust. So we have come up with the fee. We based it on incremental costs. And what the incremental cost was the work that we're performing, the actuarial office, financial office, and then the auditors. We had, and I think David kind of mentioned that, the auditing costs are pretty high. We were kind of surprised, but there's a lot of work that the auditors have to do if you think about all the reports that they have to audit and opine on. We are invoicing this out to all of the school employers, and then if each county office of education would get an invoice for each of their related school districts. So.
And we had the same conversation around the trust. We just don't have a billing method in place, and so as a result, the marginal cost of putting the infrastructure in place to do the billing was such that it made no sense to charge. So same conversation, different outcome because of a different situation.
And for us, I'll just add, one of the reasons we build that structure as well is we also service a lot of our local agencies. That's actually going to be the bulk of our workload, and we do have much higher fees for the local agencies, depending whether they're a cost-sharing and agent plan. So we had to also build that billing, if you want, the system in order to collect those fees.
Okay. And then we have some resources, as Robin said. We have been updating FAQs because I know there's a lot of questions out there. Anytime we get questions, we try to put the FAQs out there so that employers have a place to get the answers to their questions. So we encourage you to go to our website and look at all the FAQs. We are continually trying to send out circular letters to inform employers about what's going on with GASB 68. I forgot to put this on there. We are having a webinar that's going to go through the report on May 21st. So if you haven't signed up for that, we encourage you to sign up for that. And we talk about we walk through the report that you will be getting, and including the allocations. And then we also have an email. So if you do have questions, we do have people that are answering via email. It's coming through my staff. So again, as Robin said, we will be gearing up for year end, and unfortunately our information is coming out in June, so we expect that in July we're going to get a lot of questions, but bear in mind we are starting to we're going through our year end too. So questions?
We do have some questions. I'll start right here.
Oh, hi there. Thank you so much, by the way, for presenting today. I do have a question. As far as CalPERS, what was the valuation date, actuarial valuation date for the information that you'll be issuing?
So we will be using the 2013 valuation and roll it forward to 14. So what you'll be receiving is a measurement date of 6/30/14.
So the same as
Correct.
CalSTRS. Perfect.
Yeah.
So that'll help us
And
with
we
our
would
census
expect to
data
have to take the 14 valuation, roll to 15, and have that available probably January, February timeframe of next year.
Okay. My second question is, with CalPERS, it's unique because you may actually have school districts that have a second plan. David mentioned law enforcement, and I have a couple larger clients that actually have a law enforcement plan in there where the rate is substantially higher than the rest of the group. And how will that be reflected in your schedule of proportionality?
So on those, basically, those plans, so you are referring to the what we call our school police that decided to contract separately for higher benefits. We treat them at CalPERS like local agencies. So you should follow all the directions we offer for local agencies. So right now, we've launched on April 1st on the My CalPERS site, the employers can go in and order their GASB 68 accounting valuations only for the local agencies. For school districts that have a separate plan for their safety employees, that's the process to obtain the valuation report. And then you will get all the information you need. And one of the different things we are doing for the local agencies, because of the way that the cost sharing is set up, we are actually doing the allocation for the employers. So the report that the public agencies will get for the cost sharing ones, the report will have the detailed allocation that we've done on their behalf. Because it is not based on contribution. We follow thanks to GASB, they listened to some of our comments in the process and added paragraph 49 to ensure that we would be able to have what we thought was a better allocation process to reflect how the cost sharing is done for local agencies at CalPERS. But the employers have to order the valuations, otherwise we will not send it to them.
We do have some questions from the web. This first question. We have a client that did not have employees in a particular CalPERS plan as of June 30, 2013. But now they do have employees in the plan for fiscal year 14-15. I'm just going to read directly. CalPERS told them they could not perform the actuary since the plan didn't have employees in 2013. how would the client report the plan and liability under GASB 68 if an actuarial cannot be obtained? And this was based on additional clarity provided on the question, if the measurement date is June 30, 2014 for the June 30, 2015 liability, and June 30, 2013 data was used, if there were no employees as of then, how would they go about that? I hope that wasn't as confusing as it sounded to me.
Yeah, I think, well, the way I'd answer it is you have to look at materiality of that. So we won't have the June 2014 actuarial reports, though, until February of 2016. So it depends on how many employees were hired. I'm assuming it's a PEPRA plan, if that's possible. So I think they're going to have to look at materiality, because we don't have the information to give to them.
Okay. But you also have to keep in mind that if you're looking at the materiality, for example, the impact on the net pension liability, when you hire new employees, they have zero net pension liability, zero. And if the employer pays the normal cost, it still remains zero. So from a maritality, at least when you look at the net pension liability, again, they should probably look to see if it's material or not, but it is a correct statement that because of the delay in the roll forward of the liabilities, these situations will occur.
Mm-hmm. And there is another question that I believe is for CalPERS. Why did CalPERS choose different lives, 20 years versus GASB's 5?
Because it's funding versus accounting. Basically, the funding rules have been in place for years. I would probably redirect the question to Mr. Bean. Why did GASB select 5 years?
That one's easy.
It was done very gracefully, right?
Yes.
That was a law.
No, it's again. No, we were trying to. I think you really have to go back to what are you trying to achieve with both approaches,
yeah.
and we're trying to achieve two things. First of all, we're trying to get an appropriate measure of a liability as of a point in time. And we're also trying to recognize the cost of the pension benefits over the service lives of the employees. And as I mentioned, many of these activities with longer amortization periods are recognized long after the employee has left service, and in some cases after the employee has passed away. So we're trying to recognize those costs within limits, of course, because we are using average. We wanted to use, the actual employee service lives, but we ran into problems, and we got some very good feedback from the actual community that because we had originally in our proposal split actives from inactives, but it causes problems for actual gains and losses because you recognize a actual, let's say somebody stayed longer than they should have, and you picked up an actual gain there, and that would be amortized over the remaining service lives, but the other side of the transaction is the actual loss on the other side, which is recognized immediately for retirees. And it just didn't work from a mathematical standpoint, so that's why we pulled together actives and inactives together in our calculations. But you're really trying to achieve two different things. We're trying to recognize cost in a period services are provided for accounting purposes. And as David will tell you, funding, what they're trying to do on an actual basis is to make sure that there's adequate resources to pay benefits when they're due.
Correct. And you also got to go back fast. If you look at CalPERS, you look at the Constitution and our board's fiduciary duties. We have, our goal is to make sure that the benefits are secure, but also the board has a responsibility to make sure that contributions are not too volatile from year to year, and that we don't put an undue burden on employers. So you got to balance all of these things. So that is why we have some of these methods in place for funding purposes.
The other thing I guess I wanted to mention too is that we talked about things that are available from CalPERS and CalSTRS, and that's in my opinion that's a wonderful service, because the questions that you have are likely something that you both have received in the past, and so by looking at the frequently asked questions and answers, can save a few phone calls. And again, you're looking at the resources right here. So, you know, and when you start taking all the number of employers that are involved, and you throw the auditors on top of that, you know, you can see thousands of calls coming in at any one time. GASB is somewhat in the same boat, and so we've taken the same approach, you know, except we're dealing with 90,000 governments and their auditors, and our staff constantly gets calls, and we actually encourage those calls. We want to be helpful. You know, we're from the GASB, we're here to help, right? But we do have implementation guides. We have an implementation guide, as I mentioned before, on Statement 68 and 67. And one change that's forthcoming is that in the past, implementation guides were considered to be level D GAAP. They were at the same level as prevalent practice. Now, one of the keys here is, you know, what's prevalent practice? What we found was prevalent practice is that if you didn't know the answer, you called your friend at the next government, and what they did, if you liked what they did, that was prevalent practice. And people use that to say, well, this is prevalent practice, and therefore I'm going to trump the implementation guide because they're at the same level in the GAAP hierarchy. There's a new standard, and I didn't put it up because it wasn't OPEB related, but it does have an impact on, it wasn't pension or OPEB related, that does have an impact on those standards, is statement number 76. And that is the new GAAP hierarchy. And the new GAAP hierarchy will take the implementation guides and raise those to level B GAAP. And as part of that process, prevalent practice will drop out of the GAAP hierarchy. So you'll no longer be able to use prevalent practice to trump an implementation guide. So please, you know, if you've, you know, implementation guides, it's big. And we re-expose the entire thing. But, you know, a lot of people use that guide to kind of prop their door open with. And that was it. Well, it is GAAP. It's always been GAAP, but it's at the same level now as an AICPA guide that's been cleared by the GASB or with a GASB technical bulletin. So please, I would encourage you, you know, as you're going through the standards, is not only to look at the standard itself, but also to look at the implementation guides. Some of the other things that we've done at GASB is that we have some plain language articles. We have a very good writer. He has a public administration background who takes our standards and actually tries to present them in a way that a normal person could actually understand it. And I realize as an accountant that's completely contrary to everything I stand for, but you know, that a normal person could actually read this. But you know, again, you're dealing with school board members that don't have an accounting background, and not only do we have, you know, a discussion of the standards, but we also have some Q&As. We developed some white papers in conjunction with the Public Pension Financial Forum, P2F2, with the NASRA, which is National Association of State Retirement Systems or Association. We looked to NCTR with the school or with the teachers' retirement systems, pulled all these groups together, including the AICPA, and said, okay, what are some of the big questions? You know, if you're up in front of a governing body or you're dealing with the media, what are some of the kind of the basic questions that you have to answer? So we try to lay out those questions and again provide some plain language responses. We provided sound bites, and then we also provided more detailed responses depending on you know, how far the person wanted to dig. So that's available through a number of websites. So I would strongly encourage you to, you know, just not read the standard and go, oh gosh, you know, how am I going to do this? There are people out there who have information available for you to help, because a friend of mine once told me, he told me this about 35 years ago, and it stuck with me to this day. He said to me, plagiarize, And I realize you should give attribution, but
Right, yeah.
you know, you're not out there by yourselves. And that's the key thing here, is there's a lot of people who put a lot of effort in place, you know, with CalPERS and CalSTRS and with GASB and many other groups to help you explain this new standard and the results of the new standard. Yes. We have a question down.
It's a follow-up question to the statement 74 and 75 that you were referencing, the OPEB, and trying to get an understanding of how is that going to, number one, is that going to increase cost? And when you were referring earlier to covered employee payroll, would the covered employee payroll, would that include the OPEB already? Or is 74 and 75 going to be an additional burden that's going to come up later?
Yeah, in response to the question, the employee covered payroll, that actually is what the OPEB standard calls for, because there's, as you probably know, there are a lot of OPEB isn't directly related to payroll at all. It could be a specific dollar amount. So the board wanted to have a measure that could be applied across the board, and so therefore they went to, rather than a pensionable or an OPEBable, I guess you would call it, payroll. What a term. We use the employee or the covered employee payroll approach. We just tried to articulate it better, although not enough to get on everybody's radar screen, with pensions, again, so that we would have a consistent basis for both pensions and OPEB. So there shouldn't be, at least from the OPEB standpoint, there shouldn't be any additional cost as far as gathering the data for that. That's already required. There certainly will be, and I realize that the big difference here is that you have the benefit of CalPERS and CalSTRS for pensions. Many of you have single employer OPEB plans, so you will be effectively not on your own, but you will have to reach out, acquire actuarial services as you did to comply with 43 and 45. And make decisions as far as assumptions. For example, a lot of people chose to use projected unit credit, as their attribution method for OPEB. Why? Well, generally because it resulted in a lower liability. But under the new proposal, and it should be finalized in June, but under this new OPEB proposal, again, rather than allowing 6 actuarial methods, it will be reduced to 1, and it will be entry age. It will be level percent of pay versus level dollar. Again, some have used a level dollar approach. So those are the types of things that you need to plan for, look at the assumptions. And again, these were assumptions that CalPERS and CalSTRS, because they set it at a plan level, they've taken care of that for you. That will be something that you have to deal with on your own. Your client will have to deal with it in addressing these new OPEB standards. So it will take some planning and work, and that's why I wanted to mention it today, because this is, there are some GASB standards that you could pick it up in the morning and essentially have it implemented that evening. There are not very many of them, but there are a few. All I'm here to tell you is that OPEB is not one of those. And as a matter of fact, you need to pick it up the minute it hits the street. We'll have it posted up to our website, by the end of June. But you need to look at that standard and start thinking about, okay, how's this going to impact my school district, or how will this impact my clients? And again, we just don't want to live in that world of surprises where everybody's shocked, shocked at the end when we've hit the effective date and, we haven't thought about it yet.
We have another question over here.
Sorry.
I'm sorry about that, but just a couple more thoughts. I'm curious as to what your idea of the auditor's obligation as it relates to the census information that we are to test, and specific to the actuarial periods that you looked at, meaning how many years of information really were you looking at when you calculated the liability?
Well, for CalSTRS, we actually rely on our auditors tested for 3 different years. One additional year was due to the timing of the census data testing, so we couldn't get a full year in the current year because we were still in the current year, so they went back. But because of the way the state's contributions are calculated, we included a prior year in budget terms, sorry about that, because the state's contributions are based on the credible compensation from the year ending in the previous fiscal year to the budget year. So it's a 3-year period to come to our contribution revenues numbers. So for 13-14, they looked at 13-14, 12-13, and 11-12, because the state's contributions were based on the 11-12 census data.
And for us, I'll try to insert, I wasn't sure about the second part of your question when you said how many years we look back to derive the liabilities. When we calculate liabilities, we take a snapshot in time, so on June 30th of 13 in this case, look at all the members in the plan on that day, and that's the basis to determine the liabilities. So we use the 13 census data to roll forward the liabilities to 13, and that's the data that our auditors have been asked to opine on or to audit. So we've only looked at the 13, and now we have completed evaluation work as of 14, and our auditors will be looking at that data over the next few months, so that that audit will be completed by the time we issue the second GASB 68 information.
Did that get your question?
Yes.
Okay.
Good.
There's one other thing I'd like to follow up on, if it's all right, and that was a comment was made of, if I'm involved in a cost-sharing plan and the liability has, proportional share of liabilities has been allocated, can I pay it off?
Right.
And, it goes to the fundamental nature of a cost-sharing plan, and that is that you share the assets and you share the liabilities. If you happen to be from the government where they're following Robin's steps and they all live to 100, they're out there exercising, eating yogurt, doing all the good things, and then you are in a plan with someone who is more like me, except I don't smoke, but smoking, drinking, eating fatty foods, and dropping dead at the age of 65, you don't want to be in the plan with Robin, because your costs are going to be higher. But the fact is, you're in that plan and you share those costs, and it is, it's not like a traditional legal liability, and I think that's the key here when you're dealing with cost sharing. When you're in a single employer or an agent plan, you have a legal liability. But with a cost sharing plan, it's a constructive obligation, and that's something that, because people say, well, if I can't pay it, how can I owe it? And but it's an allocation of the liability. As a participant of the plan, you have a piece of that liability. And so trying to convey that to people that really, they think, okay, if I've got a liability on my balance sheet, I should be able to pay it. And in this case, you can't. And it's almost like a non-callable debt in some respects, but even with non-callable debt, you can find a way to set aside resources in a trust fund and refund that debt. But in this case, there aren't mechanisms established to do that, and in some cases, because of other actuarial gains and losses, you may be setting aside more resources than you really should. So when explaining this, I would encourage folks to, again, talk about this in terms of being a constructive obligation for the government. We all know that the answer isn't zero. And so this is effectively an estimate of what your portion of the liability is. Because a lot of times people say, well, a teacher will work for somebody else for 15 years, or they'll work for them for 29 years, and then they'll come and work for us for a year. does that mean I get the entire liability for that? And there are going to be situations where it's not an equitable attribution. And but again, the board came to the point where rather than letting those stumbling blocks cause us to throw up our hands and say it can't be done, we felt that the best way to do it, again, in a perfect world, you would look at a projected contribution, and that's actually encouraged in 68, but we also realize that there's a lot of practical considerations that have to be overcome, and therefore many plans, including CalPERS and CalSTRS, have taken the actual contribution rates in which to make the proportionate share. And again, that's completely acceptable under the standards. But so you're going to have people challenge you and say, well, this number isn't exact. And I realize with governments, that's what we deal with. You know, that's why in many cases why statements take so long to get out is that people want to make this financial statements absolutely precise. And one of those reasons is because they're tied to the budget. But there are estimates involved. I mean, when you look at Cisco, you know, a worldwide company, they close their books in 3 days and, you know, get their financial statements out, you know, in less than a month. How do they do it? Estimates. And I can guarantee you they're not waiting to get every exact dollar. And I've seen, you know, again, I've been on the preparer side, I've been on the auditing side. I've seen governments that hold their books open for months because they want everything to be precise. As a matter of fact, you know, when I was at GFOA and with the certificate program, I used to see governments that would present their financial statements down to the penny. And you could always tell when they would estimate because it would be, instead of being 0.05, it would be 00. Yeah. You know, but it certainly gave the impression to the readers of those financial statements that everything was to the exact penny. And if we are going to improve the timeliness of financial reports, that is something in working, you know, with school boards and working with clients is to help break that mindset that everything has to be exact. That estimates are acceptable for financial reporting purposes. And certainly the numbers that you're getting from the retirement systems do include estimates.
The one thing I'd just like to add, because David was mentioning the cost sharing, for the school districts that do have a separate safety group with CalPERS, you will have the opportunity to pay off that net pension liability portion. So that's the slight difference. It's the way we are set up for the public agencies at CalPERS, that's a possibility.
It's treated more, even though it's cost sharing in nature, is treated more as an agent from.
Yeah, we kind of call it a hybrid agent plan. It's it's closer to an agent and a cost sharing arrangement, but it falls under the cost sharing arrangement for GASB 68 purposes.
Interesting. Just one final question over here, and then. With respect to GASB 68, we spend a lot of time focusing on the STRS and the PERS plans. Are there other plans out there that we should be considering, such as a plan with PARS, the Public Agency Retirement System, or other plans such as that need to be part of this consideration?
Yes, I think if any of you have some of the employees of the school district under PARS, because I believe there are, I'm told that PARS is going to be offering also a service to provide the accounting information for GASB 68, is what I heard. So if you do, I would suggest that you check with PARS because you're probably going to have to disclose that information.
And at least with PARS, from my understanding, that again, it meets the definition of a trust. So 67 and 68 would apply. But again, in my opening comments, and as I mentioned, GASB Statement 73, the forthcoming GASB Statement 73 is, if you do run across the plan that doesn't meet the three qualifications, the three criteria for a trust, then you will apply Statement 73. It gives you exactly the same answers, but when you look at the scope of 67 and 68, it doesn't apply to those plans that don't meet the definition of a trust.
And earlier we talked about who was going to be responsible for picking up that liability. Does CalSTRS have any plan that they offer school districts that would allow them to fund the OPEB liability through CalSTARS?
No, we don't have other post-employment benefits in terms of health care, with the exception of one very small Medicare premium payment program that's no longer available effectively.
CalPERS does offer, we call it the CERT,
Yeah.
and we have many school districts that pre-fund. Now, I don't know if they're, my guess is they're pre-funding for both teachers and their administrative employees. So CalPERS does offer that, because you don't have to be, our CERT program is open to non-CalPERS employers. And we do require the employers to acquire the services of an actuary. Not that CalPERS does not do the actuarial work. And we require that valuation to meet GASB 4345. So once the new standards are in place, CalPERS will likely require that the valuation you provide us has all the information we need for us to meet our financial statement needs.
Yeah. And that's done on an agent basis? Or
Correct.
across-
Yes.
Agent.
Yes.
It's agent.
Yes.
Yeah.
It's
Yeah.
purely an investment fund
Yes.
service.
Yeah. Yeah, the only cost-sharing plan that I'm aware of on the OPEB side, statewide, is in, I think it's Ohio that has it. This is your time. Are there any other questions? We could have talked all day, and we kind of shut things short so that we would give you a chance to ask questions. So it's easy to stump the bean, but these guys are a little tougher.